So are the banks going to crash again? We have a little good news and some really horrifying news from Professor Richard Wolff. Check it out. Leave your comments, ding the bell, share it with your friends, and please subscribe to our channel. On the line with us right now is Professor Richard Wolff, the economist and co-founder of Democracy at Work, author of numerous books. His latest is Understanding Socialism, democracyatwork.info, and rdwolff with 2fs.com are his websites. Professor Wolff, welcome back to the program.
Thank you, Tom. Glad to be here, and good luck with your flu.
Yeah, thank you. I'm on the tail end of it, so I think it's getting better. I shared a couple of stories with you in email, or Sean did, and let me just pop a couple of these stats out, and then I'm rather hysterical about that. I'm worried about this. This concerns me tremendously, and I'd like you to either explain it or talk me down off the ledge here. The first is from wolfstreet.com. Auto loans and lease balances have surged to a new record of $1.33 trillion, and subprime loans in that category, these are people with credit scores below 620, have exploded at a breathtaking rate, and the delinquencies now are up to $66 billion. They're up 15% from just the last year. We're looking at delinquencies in this area that are mind-boggling. The total market for these kind of loans is $293 billion, and $68 billion of them are more than 90 days delinquent. That's about a quarter of all subprime auto loans are delinquent. And then to make it even more bizarre, these things have been packaged into asset-based securities, which is what shut down the entire economy in 2008 when mortgages were being done this way. And now it's these car loans being done this way. And then on top of that, this piece from Raw Story and from DC Report by Maureen Neffen-Duffy, where she talks about the Commodity Futures Trading Commission, the CFTC, which regulates things like, if these things are being resold as securities, is supposed to regulate this stuff. Trump has picked apparently all 5 members of the commission. They just voted 3-2 in favor of leaving a giant hole in Dodd Frank so that the big 4 banks, and just the big 4 banks, can continue to do this. During 2016, apparently they're doing the same thing with credit cards that these other companies are doing with car loans. They opened 110 million new credit card accounts, about 50% more than in 2010. And they're also big in the credit default swap business, only this time it's consumer debt. I mentioned car loans a minute ago. Now also we've got credit cards. The Federal Reserve valued outstanding credit card loans at $1.2 trillion. Citibank, J.P. Morgan, Goldman Sachs, and Bank of America handled 90% of U.S. swap trades. This is a $300 trillion business when we have, what, a $20 trillion economy? And the big picture reveals, and I'll end with this, quote, a financial infrastructure that mimics the failed financial engineering created in the mortgage markets leading up to the 2008 financial crash. And that's from the guy who was the deputy to Brooksley Born, the chair of the CFTC during Bill Clinton's era. So explain this, what does all this mean, and what could its consequences be?
Okay. It's a mixture of good news and horrific news, so I don't know if I'm going to get you off the ledge, but maybe I'll move you around on the ledge a little bit. Here we go. The thing that the people say who have to defend what you've just described, the only thing they can say is that the auto loan business, the credit card business, and you could even add the student loan business, which, by the way, has just as scary a scenario about it as the other 2 that you just described. What the people who defend all this say is that the total size of these markets, credit markets, is smaller than the mortgage loan business. That's because more Americans have taken out more money to buy homes than have done all those other things in the way of credit. Right. Other than that, they have nothing to say. So let me pick up at that point where they fall silent. Yes, it's true. The size that they point to is correct. And so on one level, if terrible things begin to unravel in the credit card business, the auto loan business, the student loan, and all of them have been packaged into securities, sold around the world, it won't have the immediate massive effect that the crash in 2008 did. But it is exactly the same story. and it's the same explanation. In the crash of 2000, if people can go back that far in their memories, so-called dot-com crash, one of the things the government did to prevent a full-blown depression was bring interest rates very, very low. And what that did was make all the people who hustle other people's money look elsewhere. Where can I get better rate of return now that interest rates are so low? And lending to people with dubious credit, to whom you could charge fantastic interest rates, was where they went. Exactly the same thing is happening now that we have, again, a 10-year period of unusually low interest rates to prevent the crash of 2008 from being a full-blown depression. So everywhere where wealthy people have money, they are pressing their advisors, their hedge funds, to find lucrative, interest-returning, profitable investments. And lending to poor people or people with credit scores below 620 who have to pay higher interest rates because they're in that pool has attracted risky investments in the car business, in the credit card business, and so on. If those begin to fall apart, the contagion from that will lop over into the mortgage market. Let me give you a simple example. I would say half of my students who are carrying debt that they cannot ever pay back, which they tell me, is not really debt for them as students. They are helping out their parents by borrowing as students money that their parents couldn't get from anything they could borrow from, or would have to pay even higher interest rates. So the actual boundary among these different categories is a lot more porous than you might think of if the statistics are not explained. Bottom line, we are now in a full-fledged credit bubble. The government is pouring money into the economy again, like it did before the crash of 2008. That money is sloshing around and producing stock prices that are unconnected to the underlying real economy. And a good bit of that money is flowing into the hands of people with the poorest credit and therefore the highest likelihood of being unable to pay back. We have the highest levels of debt, personal, corporate, and government, in our history as a nation, which means a problem anywhere through the lending system will be a problem everywhere. Anyone who takes seriously the history of these successive bubbles has to look at the current situation and clap their hand on their forehead, as you have done, and said, oh, my God, are we so backward that we're heading into it again? And the answer to that question is yes.
Wow. So what is it about these politicians that makes this happen? I mean, you know, this easy credit thing in the late 90s, early 2000s that led to the crash of 2008, a very similar thing, I believe, in the 1920s, the Roaring 20s that led to the crash of 1929. And now you got Trump demanding that Jay Powell lower interest rates even further, which would jack credit up even higher. What is it?
That's right. They never learn. They're under the pressure of the people who have the money, who want that money to grow, who think of the system as a growth animal that will always make them more money. They put enormous pressure on the corporations whose stock they mostly own to deliver the rising rates of return. In a society like ours, where a majority of the people barely make it from month to month, producing more goods for people who can't afford them already and who are in debt over their heads is not a paying proposition. So you lend them money so they can buy a bit more. You charge big interest. Look, Mr. Johnson over in England yesterday fired his Secretary of the Treasury equivalent, the Exchequer, because he wasn't willing to pump up the economy with funny money the way Mr. Trump had led him to believe is the road to success. That's what politicians do in the system we have, and you're going to have to change that system if you expect the people at the top of it to behave otherwise.
Why, you know, the solution to this was supposed to be Dodd Frank. Why isn't it helping?
Because it's exactly the same history again as we saw. You know, out of the Great Depression came the Banking Act. It created a firewall between investment banks and commercial banks.
Glass-Steagall.
That's right. And it did a whole host of the other things that Dodd Frank did. And over the immediate period afterwards, the banks had exactly the same strategy they've had this time. You begin by evading the law, which is not that difficult to do. Then you turn with your political paid folks to weaken the law. And when finally you're capable of being strong enough politically, you get rid of the law, as they did with Glass-Steagall, that was signed out of existence in the 1990s by, it might be worth remembering, Bill Clinton as president. You're seeing exactly the same now. They delayed. There are parts of Dodd Frank passed years ago that still have not been implemented because they're studying how best to do that. That's pure evasion.
Yeah.
And so you're seeing now the weakening, and it is the same scary.
So we have 30 seconds, Professor Wolff. What can we do as individuals and as a society?
Two things. One, learn about this stuff. Pay attention to the critics. There's enough of them out there in all walks of life so that you're aware of what is being hustled by you. But the second one is to recognize that punishing a banker or passing this or that law, we've been there, we've done that. Much more basic change in this society is needed. Yes, it's scary, but not doing it ought to make you even more scared.